Hey everyone, welcome back to the channel. We're talking about multifamily apartment investing. We are live right now on YouTube. Someone just asked the question. Jordan says, good afternoon. What are some of the tactics to turn around a really bad multi-unit building? That's a good one. So how do you invest in multifamily? We're talking about lots of units. I'm talking triplex, fourplex, fiveplex, sixplex, sevenplex, 10plex, 12plex, 20 unit building. How do you turn something like that around? How do you make money in multifamily real estate investing? It's a different ball game than the single family, renting to a family, than even the student rental game, than the Airbnb play, than, even like duplex type of property, because the way that you appraise multifamily property is entirely different than the way that you appraise low 1 or 2 units, like smaller residential type deals. Because of that fundamental difference in how they appraise the property, how value is derived, you have to have a different strategy and a different approach. So because the values are different, that you come to residential real estate versus multifamily apartment building investing, you have to have a different approach. So with multifamily, net operating income, or NOI, is how you determine value. So it will trade at a cap rate. A cap rate is basically the net operating income relative to the price of the building. What that means is the more rental income you get on a multifamily building, the more it's worth. With residential real estate, that's not always the case. They like to use comparable approach. So they'll take, if the neighbor's house sold for $100,000 more, this duplex is worth $100,000 more because it is worth what the market is willing to pay. In multifamily, if you can get the expenses down, let's say you could put in coin-operated laundry and generate an extra $1,000, a month, which is like in a big building, that's totally possible. In like a 12plex or even a 15, 20 unit building, you can get $1,000 a month from a good, well-operated laundry addition, right? You just put in like a little laundry room where there was a storage room before. It's a small little thing you can do to add value to multifamily. And that's huge right there. You do one little thing like that. Or maybe you replace the whole building from inefficient incandescent light bulbs to LED light bulbs that are super efficient, that use 1/10 of the hydro cost. If that saves you $500 a month on hydro cost, over the year, that's $6,000 onto your NOI, added to your net operating income, because your net operating income is derived by all rental income, all sources of income from laundry, mostly rental income, but also laundry income and parking income, and you can rent out storage lockers and things like that. So that'll be your revenue side, all your rents and things coming in. And then you have your expenses, which is like your hydro, your utilities, all of those things that basically you have to pay to keep the building going. So like your utilities, your property taxes, maybe any fees to the city. You have like gas bills and water bills and all of the other miscellaneous property management bills and etc. PMIT is basically what I use. So P is property taxes, M is maintenance, I is insurance, and T is taxes. You basically got an income statement is effectively how you get your net operating income. So if you can decrease your expenses and increase your income, you add value to a multifamily right away. The biggest way to add value to a multifamily building is to increase the rent roll, to increase the rents. So you have to turn tenants over, fix the units up. Sometimes you don't even have to fix the units up. Sometimes it's as simple as literally getting an old tenant out who is paying half of market rent and then putting in a new tenant at market or slightly above market rents. Doing that one thing. I know someone who did that with a 12 unit building. They literally went in and said, hey, here's $1,000 a tenant per tenant that leaves, and I'm only gonna offer it to the first 6 people that take it. And people jumped on board to get on that, and 6 people were gone right away. They created that like fear. And then for $6,000, they had those units vacant and were able to go right from there to putting in 6 new tenants at top market rent. They increased the building's value by $200,000. So a $6,000 investment into evicting under market rent tenants created $200,000 in upside equity. That's the beauty about, I think, multifamily investing that makes it so attractive to investors, is that the numbers don't lie. Like, you literally just increase the rent and decrease the expenses and create a stabilized accounting record of that and show that to another investor, show that to an appraiser, and you've increased value. With residential real estate, it's a little bit trickier. They will sometimes use the net income, operating income approach to valuing property, but they mostly rely on the comparable analysis approach. And they rarely ever use the cost-based approach. So what did it cost to build the property? Mostly they use comparable analysis. In multifamily, they use the net operating income as their primary driver. They use cap rate. What is the market willing to pay for cash flow in your city, in your area? In every area, it's slightly different, but the fundamentals are guaranteed. You can buy a multifamily building, bring an appraiser through that you hire independently. And by the way, in residential, the bank hires the appraiser. In commercial multifamily, you get to hire the appraiser. You pick the appraiser. So you could call an appraiser and say, hey, I'm buying this building. I'm going to call you in a year, refinance this building. Can you walk through it with me and tell me what I would need to do to get a value of X? I'm buying this building for $800,000. what would I need to do to get $1 million appraisal? And the appraiser will walk through and say, hey, pick these 4 units, turn them over, clean them up, give me 4 clean units that I can take pictures of, and get the rent roll up to X, get the expenses down to whatever. They'll give you some strategies, and for a good $1,000 or $2,000, you can have a plan of attack to guarantee you a couple $100,000 in multifamily. The value add opportunity is very clear in multifamily. Now, there are some drawbacks to multifamily investing. There are some pros, right? I personally think that the property tax rate, mill rate, like the rate at which you pay property tax per dollar of building in multifamily is too high. Specifically in London, it is ridiculous. Like $1 million 12-plex and $1 million duplex, right? Both $1 million. $1 million duplex will have property taxes of like $6,000 a year. The $1 million multifamily building will have like an $18,000 a year property tax bill. So dollar for dollar, the expenses are way higher in multifamily because insurance rates are way higher, property tax rates are way higher, and you have to put a lot more down on multifamily unless you go through CMHC financing on the multifamily side, which you can do. You can use CMHC apartment building financing to buy 15% down on apartment buildings. You can buy $1 million building for $150,000 down or 15% down with CMHC commercial financing. Not all buildings qualify, and there's a lot of different qualifiers we could talk about in another video, but there are some distinct disadvantages. Like most lenders want 65% loan to value on large multifamily, whereas they're okay going 80% loan to value without any mortgage insurance on residential. So you typically get a better leverage ratio on the smaller residential stuff, which is why I focus on that so much. I like the large duplexes with like 10 or 20 bedrooms, like the big, massive duplexes and triplexes. I love those. And fourplexes because they get residential financing. So commercial financing, typically you're looking at like an extra percentage point higher. So we're all getting a 2.99 5-year fixed on my residential property mortgage. I might pay 4% on my commercial property mortgage. So you have higher, like I said, insurance costs, higher property taxes, typically a little bit higher fees from the city, and often you'll have higher interest rates from your bank. So you'll have a little bit higher expenses, but the value add formula is much clearer on the multifamily side. You simply have to increase your rent roll or your income by adding things like laundry or storage units or trying to charge for parking spaces or just getting the rent roll overall up, right? Getting the rents up, or simply just decreasing the expenses, ideally doing both. And as soon as you increase the net operating income, you can sell that building off to an investor who is likely more of an institutionalized investor. For some reason, and I won't get into it here, but most of the accredited investors and the institutional wealth, most of that type of money doesn't want, like the big REITs and all that kind of stuff, they don't want to buy small rinky-dinky 200,000, 300,000 deals. They don't want single family duplexes. They want to buy $1 million buildings. So what you find is these people, a lot of these large funds will get guys like Sun Life or like a big insurance company to back them with millions of dollars at like prime minus 1% and tell them to go park it in safe real estate. And they deem large multifamily as safe real estate, whereas they seem like the residential duplex, triplex as not as safe. So what I found is in the large multifamily space, there's a lot of institutional competition. What that means is they're willing to pay more for the income. They're okay with a 6% cap rate, right? A 6 cap rate or a 6% overall return on their cash. They're okay with that. Lower hurdle rate is what I found in most cases. So there are opportunities in the multifamily space. I love multifamily. You need to have big kahunas. You need to have a lot of money to make money in multifamily, but the plays you can make in multifamily can be huge. And you have to do a lot less deals to make the same amount of money. I've had to do 50 smaller, 500,000 and smaller sized deals to make the same money that I could have made doing 7 big multifamily deals. So eventually it gets to a point when I'm working with, say, 50 or $100 million in capital, I can't deploy that into small residential deals. And so you eventually have to move on to the bigger stuff. And that's just the nature of investing. I think most investors shouldn't start with large multifamily. I think the place to start is your small single family duplex, triplex, your smaller stuff. Max out your personal residential financing. And then the big distinction is with multifamily, the personal investor doesn't always qualify. The building qualifies itself. So oftentimes these big 20-unit buildings, you get the financing based on the building itself, right? You bring that financials of the building to the bank. Whereas you're buying a duplex, they're looking at your personal income. Can you personally service this property more than can the property service itself? So just a slightly different financing approval process. And that financial incentive, I think, to buy on the large side just makes it easier. I guess there's like an incentive. It's just easier to do, to buy the big multifamily as an investor that's tapped out on the personal residential side. So there's tons of nuances, tons of differences. That was just a quick video. Anyway, bye guys. Spend less, earn more, and maximize your returns. That's the secret to unlocking wealth.